Good morning, everyone. Good afternoon. I'm very happy to, I can't see you, but you can see me. This is the Roundtable on the Global Minimum Tax Initiative. When the SIEL 2021 Conference Committee was planning the agenda, it was clear that something new was happening in the OECD tax negotiations. When the United States tabled a proposal including reallocation of profits, and therefore tax revenue, from headquarters countries to countries where the markets are, plus a global minimum tax on the largest companies in the world. We didn't predict that the OECD would actually meet its deadline of July 1st to arrive at a framework solution in these negotiations. They did. The framework is posted among the papers for this conference. We're very pleased to have persuaded a great group of international experts to talk with us today, experts who are really very well equipped to talk about the OECD negotiations and what they mean for international tax politics, tax policy, and international economic law. So in alphabetical order, Professor Michael Devereux is the director of the Center for Business Taxation at the Oxford University Said Business School and a professorial fellow at Oriel College. He's a prominent figure in tax policy, particularly on the international side of corporation tax, and his work focuses on how taxes affect real economic decisions. He's led or participated in many high-level groups on tax policy in the UK and the EU. Professor Carlo Garbarino, who's I think not quite with us yet, is professor of international tax law and the director of the Tax Observatory at Bocconi University, Milan. He also teaches at the Wirtschaftsuniversität Wien. Catherine Schultz is vice president for tax and fiscal policy for the Business Roundtable, an association of CEOs of leading US-based companies. These are global companies, and she's responsible for global tax and advocacy efforts that promote US economic growth, competitiveness, and job creation. She's an expert on international tax law and has followed OECD and other negotiations in depth for over 20 years. Robert Stack is currently a managing director at Deloitte Tax LLP in Washington, D.C., where he advises on international tax policy issues. In the Obama administration, he was the Deputy Assistant Secretary for International Tax Affairs in the U.S. Treasury Department's Office of Tax Policy, where he was the U.S. negotiator in the OECD for the Base Erosion and Profit Shifting Initiative. That's Base Erosion and Profit Shifting, or BEPS. You'll hear that acronym a lot this morning. And he had over 25 years of experience before that as an international tax lawyer. Professor Attiya Waris is professor of fiscal law and policy at the University of Nairobi in Kenya. She's also an advocate, company secretary, arbitrator, and active international African and Kenyan tax law and policy. Her writings, she teaches at Nairobi, at the University of Rwanda and the University of Pretoria. Her writings include the first ever book, Mapping African Fiscal Systems and Work on Combating Tax Avoidance, as well as the first ever book, Linking Tax and Human Rights. So for those who are out there, please put your questions in the public chat. We'll take questions by writing, as I think really screen sharing is beyond me. So I think we'll start by introducing what the OECD is about, and I'd like to ask Bob to introduce where this negotiation came from. I mean, why are governments and the EU negotiating in the OECD, and what did they want to achieve?
Thanks, Amy, and thanks everyone for having me. It's terrific to be in this wonderful group of folks talking about these things. I'm going to take a bit of a wind up. I know we don't have, Mike and Kathy and I and Attiya, we're kind of tax geeks, and I know the audience is a broader group of economists. So I want to make sure we set this up so that we can be accessible and really help and have a great conversation. our notes say kind of, where did this negotiation come from? And if you'll bear with me, I'm going to back up a few years, actually into the 1990s. But for non-tax folks, I'm going to remind you of something that's pretty important that underlies virtually everything we're going to talk about today. And that is, if you think about tax, right? You kind of pay tax where you're located. So in the 1920s, when these rules were written, maybe you had a factory or a distributor in a foreign country. And of course, the big early problem of international tax was if a US company has a business in France, who gets to tax it, France or the US? And how do you avoid taxing it twice? Because as economists, you can appreciate taxing the same economic income twice is inefficient. So that was the birth of kind of everything we're going to talk about today, goes all the way back to the 1920s. Fast forward to the 1990s, and one of the problems that we have is there are two big drivers of profits. Capital, you can put a bunch of money somewhere, and intangible property. You can own intangible property, believe it or not, in a place like Bermuda. And now, where is the place that ought to get to tax the income that results from these two things that we tax folks call mobile type of assets, because you can move them around easily enough? Now let's back up to the OECD. The OECD was actually, its predecessor entity was formed after World War II among some of the large economies in order to reconstruct Europe after the war. In the early 60s, it kind of morphed into the organization we know today, the Organization for Economic Cooperation and Development, made up of mostly the large developing countries and, of course, the European countries that were there at its birth. And as a tax matter, the thing they started to do very early on was really pick up the work that had begun at the League of Nations starting back in the 1920s, and that was around helping to draft tax treaties that the countries could agree on to facilitate trade and, again, avoid double taxation. And in that role, in this what we call the Committee on Fiscal Affairs, the tax committee of the OECD, I would say up until about maybe the 90s, but more when we got into the BEPS project in 2012 and 13, the main focus was on the treaties. And the treaties had two elements. One is, well, what should a model treaty look like? And so the OECD spent a lot of time trying to help countries come together on what a model treaty should look like. And then one of the big issues in treaties is, let's go back to my French-US business. Let's say the US business sells a widget into France. Well, the price of that widget, if you think about it, is going to determine both the tax treatment in France and the tax treatment in the US. And that's the issue of what we call transfer pricing. What should that price be? Well, that's a pretty complicated topic, well beyond that simple widget. And for 50 years, the OECD has built up rules around transfer pricing along with treaties. And so I would say, until we get into this more recent history, those were the two main preoccupations of the OECD. Now let's go back to the 1990s. I mentioned mobile income. Well, mobile income was often stashed in what I'll just call informally tax havens, because you'll appreciate that, but think of them as, sandy places with zero income tax rates. And in the 90s, government started to say, we have to do something about these tax havens. And the focus in the 90s was on, well, let's try to identify what they are. Let's try to put up their criteria, and then we'll do something bad to the tax havens. And one of the things they were thinking about in the 90s was, these tax havens have zero rates. And we should begin down a road of telling countries what tax rates to have. And this work was going on under the guise of harmful tax practices back in the 90s. 2001, the Bush administration comes in and says, wait a second, we can't tell countries what rates to have. Tax competition is good because it's going to be great for the world if countries try to make themselves into environments where businesses want to be, and tax is an appropriate tool of tax competition. Now, what's fascinating about that is that kind of derailed that work that was focused on defining the characteristics of a tax haven, but it spawned a very, very important part of what's going on in international tax today, was to say, well, maybe we can't tell tax havens what rules to have, but we can come together and see that they share information, so that if a company or a person has an income or an account in a particular country, we're going to get the countries to cooperate. So France knows that some wealthy business person, has an account in a Bermuda bank. That led to what we have today called the Common Reporting Standard, where financial information is exchanged all around the world. Something called the Global Forum, which kind of enforces these exchange rules. And the US rules on FATCA were an important impetus to pushing forward this information exchange. But the problem of the instability caused by tax havens in the international tax system persisted. And in around 2013, the OECD said, hey, instead of focusing on calling out the havens and defining what they do bad and punishing them, why don't we, the developed countries, look at our rules that permit the kind of tax arbitrage that the tax havens can facilitate? And that was really the beginning of the BEPS project. And the BEPS project, which began in 2013, I would say I'm going to give it two tracks. One track was fixing all these rules. So again, as economists, I'll just say simply, you could have a situation where I can take a deduction and reduce my taxes in my country, but when I make that deductible payment to you in your country, there's no tax on it because of the alchemy of tax planning. And BEPS was trying to kind of eliminate these arbitrage opportunities in the international tax system. And that was a big chunk of BEPS, including some work around transfer pricing. Now let's get to the subject of today. Issue number one, though, in BEPS was taxation of the digital economy. And taxation of the digital economy became an issue because, let's go back to my opening example of that factory in France. Well, when the factory was in France, the income was earned in France. France could tax the income. It knew where the expenses were because, after all, income taxes are net. It's gross minus expenses. And the world kind of went along with that system for many years. But the rest of the world started to say, wait a second, these tech giants can make a bundle in a country without really needing that factory. They can just earn advertising revenue and they never really have to be in my country. And maybe we should revisit those early rules, which were built around the need for a physical presence in a country before that country got to attach taxing rights. Now, I was the US representative at the time of BEPS. The rest of the world made a couple of other arguments. It said, this digital stuff is so different. It depends on things like network effects, and it takes data from people. And you know what? When people put pictures of their cats on social media, they're contributing to the value of that company. And the country where the cat picture putter is should get some right to tax that income. The US, on the other hand, which I represented at the time, said, wait a second, everybody. We get these differences, but these are all US companies at the time, back in 2013. And it felt a little bit politically like the rest of the world wanted to rewrite the tax rules, with the only effect being on the US tech giants. China at the time had a much more domestic market and was not necessarily a huge player yet in this whole tech area. So the US was very resistant to kind of rewriting the rules just to take money from the US fisc, from US companies. That political problem led us to where we are today, because over 3 administrations now, Obama, Trump, and now Biden, of 2 different political parties, the US stance was, okay, we'll rewrite the rules, but we're only going to rewrite the rules if they're going to apply to not just tech giants, but to a large number of big, well-to-do companies. And what was the driver of it? The driver, going back to my example of the person that puts pictures of cats, was that the market jurisdictions somehow were getting shortchanged in the global rules as having been applied from 100 years ago. And we needed to change the rules to put more money in the markets. And as the negotiations have progressed, the U.S. and the agreement reached over the last couple of weeks did broaden the scope. So it's not just tech companies anymore. We'll talk about the details, but broadens it out beyond U.S. tech as setting the table for this. One last point on the negotiations and the OECD. The OECD is an organization of about 37 countries. When we did the BEPS project, it became an OECD G20 project. And that meant there were more countries around the table, countries like China, South Africa, India, that are not part of the OECD, were part of the G20 conference. And then after the Addis Ababa conference in 2015 or 16, the OECD was broadened to include a lot of developing countries. So there's now 139 countries around the table working through these issues today. So a long trajectory, give more to the markets, US position, don't just tax tech, to get there, and all the countries around the table. One last word on Pillar 2, because what I just described is Pillar 1, which is to give more taxing rights to markets. Now, when the US proposed broadening Pillar 1 so that you were giving more taxing rights to markets, not just for tech companies, but for a lot of companies like big fancy brand names, some of the European countries sat up and said, wait a second, we never thought Pillar 1 was going to be about our companies. We thought it was just about your companies. And they put on the table Pillar 2, because they said BEPS had nothing to do with who taxes things where. BEPS was all about making sure companies pay their fair share. And that's what a minimum tax will do. And we fast forward, and Pascal Saint-Amand, who's the director of the Center for Tax Policy at the OECD, is a bit of a political genius. He convinced both sides to keep both pillars on the table, moving down the track, and now they're tied at the hip. So we have Pillar 1 and Pillar 2. And with that, Amy, I'll turn it back to you and hope I've set the table okay.
One last thing. I think people in the audience won't really we could use how exactly does the OECD do decisions by consensus?
Oh yeah, so it's a consensus organization. In fact, when Kathy, I remember because I was at Treasury and Kathy was working also in the U.S. business community, and the joke I used to make is because everybody wanted to tax U.S. companies when I was doing BEPS, and it's a consensus organization, I used to say, I have a feeling that the question for consensus is, should Bob buy everyone's lunch? Because after all, the US would have one view of that question, but everybody else in the room thought it was a fine idea if we bought everyone's lunch. Now, consensus isn't everybody raising their hand and voting affirmatively. It really operates through an absence of objection. And so documents that come out from the OECD historically mean they came out, no one objected. The Secretariat, which is kind of the office people at the OECD, play a very, very strong role in drafting the documents with something called a steering committee, which is now a group of about 30 countries out of the 139, to bring things forward to the OECD where it happens without objection. Now, the document that just came out the other day took a different tack. It put out a statement and let countries sign up to the statement. And as we'll talk about it, it did not demand absence of objection. It basically opened the document and said, hey, countries, sign up or not. And they got 131 out of 139 countries signed up to the document that came out the other day, which I'll just say is a big deal to get that much around, a statement with that much detail in it. So absence of objection, consensus, everyone's in the room at the end, but a lot of tricky politics around objecting to something that the world is kind of moving towards.
So does anyone else have, like Attiya, what was the viewpoint of the developing countries? And I think Mike Devereux also has some views to add to this.
Yes, and I also would like to add something about what Bob just said about consensus management.
Okay, Attiya first.
Thank you very much. So thanks, Bob, for the American understanding of the historical progression of this entire debate. And I say that on purpose, but with a lot of respect. I think that one of the biggest problems with this debate or discussion on the history of the OECD always bypasses the most basic issue, which is that developing countries are not member states. I will not belabor the point, but it is a consistent problem. Every developing country in the world will come back to you over and over again and say this. So when they're not member states, this leads to the whole consensus issue. Is what kind of consensus are they giving? And what is the extent of that consensus? And some people say political genius, I would say borderline bully. So, you know, again, we need to talk about how this is taking place. And for an organization that moved on consensus, that suddenly decided, come and sign up, it means because there wasn't consensus. And I think it's really important to bring that front and center. It was the only way out for them.
That's a brilliant observation. I fully take that point. Yep.
Thank you, Bob. So, but if we talk about the historical issue, these are historical issues not only in tax, but these are historical issues in many different fields of law across the world. The UN got set up, the OECD got set up at a point in time when most countries were not independent. So even the debates and the discussions that took place at that point in time were a lot of imperial countries making positions on behalf of their colonies as well. Now you fast forward through that process, and you now have OECD, which is now, of course, all independent states, and now you have a set of ex-colonies, let's say, floating around in the world. And now what you have is a scenario where the rules that were set in place were themselves already problematic at the OECD, because the size of the economies, can you hear me? Sorry, somebody in the chat box is saying.
Yes.
Okay. So the size of the economies are now very, very different from the sizes we started out with right at the beginning. And as you take the whole tax debate through this, I want to add a nuance to this. OECD did not willingly set up the BEPS project. We have to recognize the influence of civil societies like Tax Justice Network. There was this huge push. People were stuck because the system was now blowing open. There were demands for these sort of things like country by country reporting, which of course went into the pillars. When I bring the conversation now into digital taxation, now this is where for the whole problem of consensus becomes, you know, front and center. Out of the 24 African countries in that debate on digital economy and minimum tax, only 8 of them have some kind of digital service tax, whether it's customs or otherwise. So again, even the ones in the space giving consensus in whatever way you want to define it, there's a lesser financial problem for them. And look at the ones holding out. From an African perspective, Nigeria and Kenya, 2 very critical countries, both of whom have tax systems. Now I'm going to take you backwards in history again. For the past 20 years, we've had a customs moratorium on digital services and goods. Now, that is a huge problem for developing countries. So we have this moratorium that is constantly being pushed forward by 2 years. It's now 22 years old. And now we are coming into the other field of income tax. So customs is now out. Now we are dealing with income tax, and now we are putting a 15% cap on it. I mean, all these debates have to sort of come together to a certain extent. And I know as tax geeks, as Bob says, we leave customs out of our debates. But for developing country people, it's all about the revenue in the entire pot also that needs to sort of be recognized. I'll stop there because I think everyone has a position here.
Yeah,
Thank you.
I think. Carlo?
Yes, I fully share the remarks by Attiya, which I thank, whom I thank. I mean, it's amazing how, you know, a consensus of 130 countries come out of the, you know, of the hat like that, and it's clearly the fact that apart from the criticism that can be rightly moved by developing country, it is clearly the fact that there is no idea of an architecture of some sort of governance of international taxation at the OECD level. So they go on with the old model of soft law guidelines for implementation, And now, in addition, there is this obfuscation of, an overload of technicalities. When I read the summary of the July 2, decision or agreement, as they call it, I had to read it 3 times. I'm one of specialists. This is my job, and it was difficult to understand the jargon. And if you read that 4 or 5 pages as a specialist, it's full of booby traps and obfuscation. So, I mean, it's like, man, what are they going to do next? So, it's the management of the image of the OECD that as Bob rightly said, has wonderfully managed the tax treaty in the last century. We are way beyond double taxation. We are in the world of double exemption and BEPS. So it's okay, the tax treaty, but this is stuff that it is not useful for addressing global issues. So, tax competition, the race to the bottom is very similar. Of course, there are differences to climate change. It's a global problem. We have to address the problem altogether through cooperation. And I don't think that what the OECD is doing is okay just because they lack the design, the architecture. You need an architecture. You need some sort of governance. Now, this is, the bad. What is the good? The good, as Bob said, is that, Pillar 1 and Pillar 2 are like 2 wings of a bird. You need 2 wings to fly, right? So, the bias of the OECD is that once you have Pillar 1, you're okay because you can allocate profits. This is not right. You need the taxation in the whole country of the multinationals. So it is governments against multinationals. So if you want to interact strategically with the full mobility of capital, you have to go outside of the realm of market efficiency or drafting market jurisdiction source or destination rules. You also have to add attribute to home countries, which are mostly OECD countries, and primarily the US, the responsibility of tax regulating their own multinationals that have their headquarters in the country. Now, critics say, well, they can exit, they can migrate and all this kind of stuff. Of course, this is an issue, but can be addressed, and is a strategic issue. So, again, I was impressed by the move by the Biden administration, because, of course, the US have national interest in doing what they are doing, because they realized that they were being damaged by the race to the bottom, and the only way to address, tax competition is to fully tax profits. If you fully tax profit at 21 or 18%, you can have Bermuda or Hungary or Ireland or any country lowering the tax rates, but the profits will be in any case taxed.
Well, thank you.
To the home country to decide market. So that's the point that should be discussed. So the good is that you have Pillar 1 and Pillar 2, and you can work on both. But I think that the primary pillar is Pillar 2, and the secondary pillar is Pillar 1. So it's the other way around. And that's it. That's the point. So I will develop this in my intervention later when we speak.
So, Mike, you're holding up your pencil.
If I may, I mean, I know we want to get onto the details, but this is still by way of introduction, really. And I mean, Bob did a great introduction, but I just wanted to pick up some of the things, and actually it relates to what Carlo just said, as to whether this is still governments versus multinationals. I think, in the first BEPS project that Bob spoke about, the problem, and as Attiya also mentioned, the problem is multinationals are shifting their profits to, let's call them tax havens. They're not paying enough tax. Let's kind of find ways to stop that happening. And that, that's, if governments are sitting together in a room thinking of that, then, it's not so hard to come up with an agreement on that, because basically we're trying to beat up on the multinationals and make them pay more tax. I think where we are now, as Bob was saying, I think it's quite different, really. This is governments against governments. Bob starts from the US perspective saying, these European countries, they're trying to tax our multinationals, and we're pretty upset about that. So I think where we are now is really saying it's much more about the allocation of taxing rights for the profits between governments. And I think you see that particularly, the focus of it was on digital companies. And, my own country, the UK, is kind of ties itself into knots to kind of trying to come up with a rationale for why we should be taxing Google and Facebook. But actually, it seems to me the reason is, and I quote Willie Sutton on this. So Willie Sutton is an American bank robber. And when asked, why do you tax banks? He said, well, that's where the money is. So I agree with Bob. We want to tax Google because there's a lot of money there. So we come up with ways of doing that with the digital services tax. And I think this is at the heart of what the issues are now. I think that there is another issue as well, though, which is tax competition. And I think the Biden administration is really kind of taking a different view on this than previous administrations. And the Biden plan is, it says it's the Made in America tax plan. And what Biden claims to be worried about is American jobs, or so-called American jobs, moving in outside America. And that's because, Biden wants to increase the tax rate in the US to 28%. That's going to, if the American multinationals are going to be paying a much lower rate of tax, elsewhere in the world, then they'll go elsewhere in the world. And maybe that's bad for American jobs. So, the US says, okay, well, let's have a minimum tax rate of 21% on all the profits they make in the rest of the world, then the differential is not too bad. The problem with that is that actually all the other multinationals in the world may be paying less than 21%, and that would give a competitive advantage to them relative to the US multinationals. So what can we do as the Biden administration? We'll make everybody else have a 21% rate as well, and that's now been negotiated down to 15. But I think that, those kind of tax competition issues are kind of underlying things as well. And, so where do we get, I would like to think, we've had kind of like an academic study. We've figured out what the problems of the international tax system are. We've come up with kind of well-designed answers to that. But actually, as Bob said, we've got two kinds of answers. We've got a messy compromise now between, the kind of position where we should be taxing more in the market country and the position where we should be taxing more in the headquarter country. Both of those are kind of pretty new, especially the market country. They're moving the international tax system in two completely different directions simultaneously. The other real problem with the international tax system, which is definitely not being addressed here, is it's horrendously complex, creates enormous uncertainty, and all of this is just going to make all of that much, much worse.
So so Kathy, where is U.S. business in, or let's say multinational business in all this? And also, I'd like to ask you. We need to sort of present what happened in April 2021 when the Biden administration put forward their new proposal. And by the way, the copy of the proposal is also posted among the conference papers.
Sure, thanks, Amy. Multinational businesses have been involved in all of the processes since the beginning. We were involved in some of the changes that were made in the 1990s that Bob described. And also the OECD was working on the taxation of intangibles well prior to when the BEPS project first came in, because there was concern about companies being able to move their IP and their intangibles to different countries. So this was not new when BEPS came in. BEPS sort of made it a little bit more political and changed the time frame that we were working on this. This was more of a deliberate time frame of looking at it, having some discussion, and coming back and revisiting it to see if we could fine tune it a little bit better. When BEPS came along, there were significant changes, and companies responded to that. They had a lot of changes that basically required companies to move from the islands where Bob was talking about to actual places where they had their operations, so that you couldn't keep your IP in one place and have your operations and your people in another place. And that was all part of the BEPS project. The companies actually shifted where their IP was so that their IP and their companies and all of their operations were in the same country. Most of these were not tax havens. They were the countries where they were doing business. As part of this, there is this perception that American companies would leave the U.S. if the tax rates were lower. Companies have been operating in foreign jurisdictions for over 100 years, and for our companies in up to 230 countries and jurisdictions and territories. Companies are in other jurisdictions, not for tax purposes, but that's where the business is. That's where their markets are. They want to be close to their markets. They put their business close to the operating where they're doing their markets. You want to sell a car in Germany, you're not going to ship it from the United States to Germany. You're going to build a plant in Germany to sell cars in Germany. That's how international business works. Companies have obviously done a lot of tax planning over the years to try to minimize their taxes as much as possible. The BEPS project slowed that down considerably, and so companies had to reorganize where and how they were doing business. In 2017, the United States passed the Tax Cuts and Jobs Act, which was a U.S. tax reform proposal. As part of that proposal, they lowered the U.S. rate, which at that point had been the highest in the OECD, to the middle of the pack. So now, instead of a race to the bottom, we went very strongly as a race to the middle of the OECD numbers. But as part of that, they also instituted a global minimum tax, a tax on U.S. companies that was originally supposed to be on their intangible assets so that they couldn't move around the world. Unfortunately, the way it actually works in practice is that it's on tangible and intangible assets. So companies are not necessarily in low tax jurisdictions. They can be in high tax jurisdictions and still be paying this tax. It's called GILTI, Global Intangible Low Tax Income, which is a misnomer because it is actually not necessarily on low tax income anymore. The way the U.S. tax system works, we have foreign tax credit rules that allocate expenses between U.S. companies and their foreign operations. We have different rules in how GILTI works, so that for U.S. companies, if you look at a 15% global minimum tax, most companies are already paying above that under the GILTI rate. If the U.S. says the Biden administration has proposed going to a 21% rate, the 21% rate for U.S. companies is effectively, because of our rules and how they are calculated, is effectively 26.5% to 28%. So if the rest of the world has a 15% rate and we have a 26.5% to 28% rate, that delta is still going to put U.S. companies further behind. For U.S. multinationals particularly, they look at it and say, we have had a minimum tax on us for 4 years. No one else has adopted a minimum tax. At any point, any other country could put a minimum tax on their operations. They have not done that. The U.S. Put the 15% on the table. The G7 acted on it. And so we're moving forward with a discussion of 15%. But American companies are looking at that and saying, even if we were at 15%, based on our allocation rules and how our foreign tax credits work, we would be around 21 or 22%. So American companies would still be behind everyone else. The OECD, as Bob described, we have Pillar 1 and Pillar 2. When the Biden administration came in, the Pillar 1 discussions were relatively stuck. And it wasn't just because the previous administration had asked for a safe harbor to say whether companies could participate in this or not, but it was more or less that it was very difficult to define what was a digital company and what was a consumer-facing company and what the parameters were going to be around those definitions. And so that had been going on for quite some time, and it really wasn't moving forward. When the Biden administration came in, they put a different discussion on the table under Pillar 1 on talking about sort of the largest countries and companies in the world and how they were going to be taxed and how their profits were going to be reallocated. So the Pillar 1 sort of started to move forward. By having Pillar 1 move forward, we also had a rediscussion of how Pillar 2 was going to work. Pillar 2 was always going to be a little bit different proposal anyway, because it was a minimum tax, as Bob explained, put forward by countries who decided we needed to have more of a minimum tax included in that. For multinationals in the US, we are looking at it as, where are we going to be in this and how are the rules going to affect us? If the rules are changed and our GILTI rules are part of this discussion, we are still going to be in a different competitive environment than other countries and companies who will put a minimum tax on their own companies. This minimum tax is collected by your parent government. So the guilty on U.S. companies is collected by the American government. It's not shared elsewhere. If there is a minimum tax, we expect that other governments will try to impose additional minimum taxes on U.S. companies. And again, as Michael said, this could get very complicated because if we go into Pillar 1 and we're doing reallocation of profits to some market jurisdictions, the question then becomes potentially on ordering rules as to what part of that profit is going to be part of a foreign tax credit back to the home country, depending on how these are designed. And then what happens with the minimum tax, and does that come before or after the Pillar 1 reallocation? There's a lot of complicated rules that will have to be resolved as part of this, and we're going to discuss that further. But for multinationals, the biggest thing that we really need is stability in the tax system. Companies need to know where the taxes are going to be paid and how much tax is going to be reallocated. And there's several other issues that they care a great deal about, but having some sort of stability and not changing these rules on a regular basis is a big part of it.
Amy, could I just jump in? I want to go back to something Mike said that I think is, hit the nail on the head from the Biden folks. We haven't mentioned the word infrastructure, but we should. When the Biden folks came in, they said, we want to rebuild American infrastructure coming out of COVID. Now, the rest of the world has a variety of tools to use to raise tax, one of which being the VAT, the value-added taxes around the world. The United States doesn't have a value-added tax, and it's pretty much accepted wisdom that politically we're not going to be able to get there anytime soon. That leaves the US fisc with kind of two buckets, a corporate tax bucket and an individual tax bucket. On the corporate tax, the Biden folks wanted to raise the headline rate to pay for this infrastructure to 28, as has been mentioned, and the min tax to 21, as has been mentioned. But the point Mike made that cannot be overlooked, the US Treasury's interest in Pillar 1 and Pillar 2 was very, very focused on the point that Mike and Kathy have made, which is, holy mackerel, if we go to 21 and the rest of the world doesn't have a min tax, Congress is not going to give us our increase in the min tax. So we need the Biden administration to convince Congress that we're going to be successful at getting the rest of the world to increase the minimum tax rate. And this has been in Secretary Yellen's confirmation hearing, all throughout the narrative. In fact, when the agreement came out the other day, the US administration was touting the minimum tax element of this. And I think once the US came on board to push the min tax, which it needed for domestic political purposes, it also came up, as Kathy said, with, I think, a creative approach to Pillar 1. Mike and Richard Collier have just written a paper that says that's where the money is in these big companies, whether they're digital or consumer facing. And so in effect, Pillar 2 kind of followed along the Biden administration's chief goal of getting Pillar 2 to increase that min tax rate. So I just wanted to set the table on that.
So Mike, actually that brings us to the, but if we could just, I'm really conscious that time is going by. Mike, can you please just briefly tell us what's in Pillar 1 in the July agreement?
Yeah, sure. Thanks. So, I mean, the kind of key thing and the kind of real big deal here is that for the first time in 100 years, or first time ever, actually there is going to be taxation in the place where companies make a sale because that's where they make a sale, not because they've got kind of physical assets there or employees or anything else. So that's kind of moving to taxing in the market country. That's completely new. As a matter of fact, I think this is a great idea. I think this is the future for the international tax system because it solves many of the problems of tax avoidance, economic efficiency, and many other things. And I've been advocating it for 20 years. However, what we have as of July the 1st is a very, very tentative first step in this direction. And so that there's been some negotiation over the last few months about exactly who this tax will apply to. Basically, the way that it will work is that we will look at the consolidated accounts of multinational businesses. We will look at their profitability measured as pre-tax profits divided by revenue. If that's higher than 10%, then we will take between 20 and 30% of the excess over that 10% and say, okay, that's the bit we're going to allocate to markets, and we're going to allocate to markets on the basis of where they make their sales. So that's the kind of basic idea. So it's, if you think of a company which makes a rate of return of 15% over its revenue, we're going to take away the first 10. We're going to take the excess profit of 5. We're going to take something like 20% of that. So it'll be 1% of the revenue of that profit. That we're going to allocate that to market countries. Now, there's a problem then is, okay, well, we're not actually taking away anything in the existing system while we're doing this. So, in other things being equal, that's going to be double taxation. So actually, we need to figure out where we're going to take that 1% away from somewhere else in the world. And there's, a set of complicated rules which are not really part of the agreement from July the 1st, to have to say, as to how we're going to take it away from somewhere else to avoid double taxation. And the other thing to note is, there's been a debate as to, well, who should we apply this to? Back in October of last year, when the OECD put forward a kind of 300-page document with quite a lot of detail, the idea was this is probably going to apply to companies with global revenue of more than 750 million euros. But it would only apply to companies in 2 sectors. That's automated digital services and consumer-facing businesses, which I think Bob just mentioned. So bring that forward to April and the Biden proposal. I think the rest of the world was kind of waiting for the new president to kind of figure out what he was going to do. And what Biden said is, let's not apply it just to automated digital services and consumer-facing business. Let's apply it to everybody. However, let's also raise this threshold, not from 750 million, and I think the Biden administration said $20 billion. The agreement as of July the 1st is 20 billion euros. Okay, who's going to be affected by this? Well, with one of my colleagues who kind of crunched the numbers and looked at the world's biggest companies. So if you look at the world's biggest 500 companies, we think that only about 78 of those are actually going to be affected by Amount A, by Pillar 1 in this way. That's for 2 kinds of reasons. First of all, it's not going to apply to the financial sector, and it's not going to apply to the extractive sector. So that takes out a bunch of companies. The other big thing is that many of these companies don't earn a rate of profit in excess of 10% of revenue. That takes out most of the rest. So we are left with, our estimate is 78, but it's think of it as being 100 or a bit less than 100 perhaps of the world's companies are going to be affected by this. So I think this is, in a sense, is a really big deal, because this is really a fundamental change in the way that the international tax system works. In another sense, it's tiny, because we're talking about a small part of the profits of 100 companies being affected by this.
So again, Mike's paper on this subject is posted among the papers for the conference.
Yeah.
Another question. Question for, I guess, perhaps Kathy or Bob. The July 1st OECD summary talks about dispute prevention and resolution mechanisms to avoid double taxation for Amount A in a mandatory and binding manner. And why is this important? And how is it going to relate to dispute settlement under existing tax treaties? I'm just asking about this because this is a trade law professors conference, and where people light up at the words dispute settlement.
Kathy, I'll defer to you.
Sure. Under the treaties, right now, when you look at dispute settlement, it's very different than how disputes are handled in the trade area, I should say. When there is a dispute, and Bob talked about the transfer pricing issues before, there's often disputes between countries on who has the right to tax a particular company and what that amount actually is. Under bilateral tax treaties, there is a mechanism for those countries to get together and to try to resolve those differences through something called the mutual agreement process, which is MAP, and they work out a difference so that the countries can work together. Under these new processes, we fully expect that there's going to be disputes over how much of this income that's reallocated is going to go to a particular jurisdiction. Mandatory and binding really matter for several different reasons when you talk about dispute resolution. There are ways to resolve disputes that take quite a bit of time. And if two countries are fighting over a piece of revenue from a particular company, say Bob's Widget Company, France and the US say the widget company owes me $100, and the widget company says, no, I only owe you $50. Those countries would get together, France and the US would get together and resolve those differences. But France is sitting on that $100, and they're saying, well, we're not really sure we want to resolve that very quickly because we have the money. And we can take our time about trying to find a time to resolve this. If you go into, instead of 100, maybe it's $100 million, and that country is holding that money, the company is out of that, and they're saying, no, we only owe you 50 million. There is no easy way to resolve that if there is no binding arbitration or mandatory way to resolve this. If you say you can have that money, but within 2 years, the governments who have this dispute have to resolve their differences, or it goes to a third party to resolve it as a backstop, it forces countries to come to the table to resolve the dispute in a timely manner. It also makes it so that countries can't say, we'll say you only have to pay 75 million instead of 100 million if you don't go get your government involved and ask us to resolve this dispute between the two nations. And so by having the binding arbitration, it keeps countries honest so that they have no option but to try to resolve these disputes. And by making a time frame on it, it means that those disputes will be resolved in a timely manner so that the money that is at stake is not held up for longer than necessary. And so that getting countries to agree to this is a critical part of this. We fully expect that when we get into the discussions under reallocation of profits, that there could be a dispute between various countries over the exact same amount that should be allocated to that market. And so rather than having that company be in a bilateral or multilateral dispute, there has to be some sort of a dispute resolution mechanism built into this process so that when these disputes arise, there's an easy way for them to be resolved. In the BEPS project, they design a multilateral instrument for this purpose, so that if two governments signed on to a multilateral agreement and then with each other agreed to the terms that were under that agreement, they could resolve their treaty disputes and update their treaties at the same time with each other. The US does not go into multilateral agreements because it's very difficult to get those through our Senate. But we hope that as this process moves forward, that robust dispute resolution mechanisms, including mandatory and binding, arbitration, or at least mandatory and binding, are included in this so that these disputes can be resolved in a timely manner.
So the rest thing, the other part of the package in July was Pillar 2. Bob, can you tell us, just in a nutshell, what is in Pillar 2? I mean, what does it add up to?
Well, Pillar 2 is a set of rules that countries can sign up to if they want, as was put out in the document. And it has two pieces to it. One, a country can have an income inclusion rule. That means a minimum tax, so that all the subsidiaries under the parent country, if they don't pay a minimum tax in those jurisdictions, then the top country gets to collect the difference. So I'll give you an example. UK adopts a minimum tax. A UK entity has a Bermuda sub. Bermuda earns $100, pays no tax. Let's assume the minimum rate is 15. That UK company pays $15 of tax in the UK because it was not paid in Bermuda. But there's a backstop. Now let's say it's Bermuda's that's the parent company. And Bermuda says, well, we don't really want a minimum tax. We don't even have a corporate tax. Now there's a rule called the undertax payment rule that says, okay, Bermuda doesn't have an income inclusion rule. Now other countries that have subsidiaries underneath Bermuda can, under some complicated rules, deny deductions among those countries to be sure that that income flowing into Bermuda does not escape tax altogether. That's a backstop rule called the undertax payment rule, and it operates by the subsidiary countries denying deductions simply because the top co didn't adopt a minimum tax rate. So I'll leave it at that. I think Attiya had a point she wanted to make, and maybe the developing countries, as I said, all that money goes up to the residence countries, and the developing countries said, hey, what about us? And they had a rule called the subject to tax rule, but maybe you want to talk about that, Attiya.
Thanks, Bob.
Yes.
No, Amy, I wanted to respond to what Catherine said about mandatory arbitration. I mean, this is actually a very hot, problematic issue, not only at the OECD, but also at the United Nations, which we've actually not talked about till now. And I think it's really important to recognize that there is a UN tax committee, and there are rules and regulations being developed there as well. But there is constant politicking out of OECD member states that tends to block the activity at the UN. And that's like a whole other conversation, so I will leave it at that. But mandatory arbitration has a particularly big problem when it comes to taxpayer money. But taxpayer money is public money. And in most countries in the world, not only developing, but also developed countries, taxpayers know how much their countries are collecting and therefore how they're using them. And one of the biggest problems with arbitration is that the rulings are confidential. You cannot even tell how the awards were made. Now, this is a fundamental problem. There's a constant pushback from developing countries about maps. But now let's talk about what Michael says. If there are only 78 countries, Michael, I'd like to know how many are African multinationals. I wouldn't be surprised if there are absolutely none, right? So sometimes I think this whole debate becomes like a storm in a teacup, because if developing countries that have, by consensus, said nothing, don't mind mandatory arbitration, don't talk about the income tax rate that's going to be used, but it's for a very simple reason. Politically and strategically, it has zero impact on their multinationals. And the only thing they're going to stand to get is some kind of 20% of 1% that we're not quite sure about, which is Michael's description of it. And then now here we are talking about mandatory arbitration. Now, let's talk about who the arbitrators are. There are almost no African arbitrators in ICC, in ICSID. There's been a huge push to get more African arbitrators there. There's also been a big push to get more female arbitrators there. So these are very fundamental problems in those private dispute resolutions that we don't talk about when we move to mandatory arbitration. But there is something that Catherine says that gives me a little bit of concern. The argument I always hear from multinationals is that it'll be faster in MAP. I have been in arbitrations that have taken 10 to 20 years. So there isn't a guarantee that the arbitration is going to take 1 to 2 years. On the other hand, I've been in tax disputes in judiciaries in African countries where there are already fixed timelines on getting these things resolved because taxpayer money is so important. So it's really important that we start to open up a lot of these spaces. So I think some of the discussion needs. Carlo also wanted to say something. I don't know if he wants to jump in.
Yes, I would like just to add a comment about the narrative, whether that Catherine was mentioning, whether multinationals, it's good for business for multinational. I think that we are not talking about for the multinational. We are talking about whether we want to address as the international community a global problem, which is unfair tax competition. And so, going back to, seminal work by Michael 20, 30 years ago, we have a concept in our discipline, which is capital export neutrality. So the residence country can set the rate, whatever rate they decide, and will apply that rate on a planetary basis. And so, of course, if the rates of the other countries are lower, there will be a so-called, they call it now top-up tax, but what's called soak-up tax. And this is what works for any individual. after the FATCA, saga, any individual in the world is recognized that we have to pay taxes in our country of residence. That's the same for multinationals. And we don't really know how come U.S. multinationals end up paying 27% if the nominal rate is 21%. That is my ignorance. But they still would pay 7 points less than the basic rate. And then, of course, if a residence country wants that the multinational are not mistreated, they can give a credit for taxes. So, that there will be only the top-up tax. So I don't think it's an issue treating multinational well or bad. They have been enjoying for the last 50 years very advantageous treatment, and so now they have to pay at least taxes in the country of which I said is new pillar. Let's call it pillar A rather than pillar 1. And then, of course, there is pillar B that is extremely important because it protects the interest of the country. Last question, which would be interesting because we always talk about from an OECD point of view, but and I'm really ignorant about that. I would hear from maybe the other speakers why developing countries and BRICS, big powerhouses like China, would agree to this deal. Well, I think that one possible reason is that there would be a backup function of OECD countries taxing the multinationals, which is their duty. So I think that's the reason why a developing country should, or maybe a BRIC country should agree about this deal, because they know that in any case, the multinational will pay taxes in their own country. And then, of course, there will be pillar 1 to add them to, enforce the territorial tax jurisdiction as we use today. So I think that's an interesting point.
So that gets us to the whole question of.
Amy, Mike wanted to make a point there. Mike.
Well, if I could, it's a kind of another developing country point on pillar 2, really, which is let's take an example where we have an American multinational with a subsidiary in Kenya, which is doing business and making profit in Kenya, but the profit is being shifted out to Bermuda. So the pillar 2 question would be, okay, well, there's no tax being paid in Bermuda. Somebody's going to levy tax of 15% here. The pillar 2 proposal is the US should levy it. It's not clear that it should be the US and not Kenya is the kind of main point. I mean, it might be more difficult for Kenya to figure it out. The only justification given the OECD documents, well, it's a kind of bit easier if we kind of just give it to the country of the parent. But that clearly has a kind of big distributional level impact on who gets this money. And I think it kind of comes back in a way to, why does the US want to do this? Is it because it wants to get more revenue, or is it because it wants to kind of level the playing fields or kind of have jobs in America and all those kind of issues?
That's great. So,
if I can take this opportunity, because we never meet, just 1 second. But I think that if pillar 1 and pillar 2 are on the table, the multinational will be taxed in the US, but also Kenya would take under pillar 1 its fair share, and then there is an issue of foreign tax credit in the US, and the loser in this game would be Bermuda. Isn't that?
Not much. I mean, suppose let's assume the multinational has revenues of only $10 billion, and then it's not going to be taxed under pillar 1 at all. I think pillar 2 is going to have a bigger impact on revenue than pillar 1 is, I think.
So we're now about an hour into the discussion. Can we talk about how we got to the July 1st outline? I mean, this was a remarkably fast negotiation from April, I guess, when things really got going in April, to the end of June. But of course, that's why the output is a 5-page outline, and there are so many details left to fill in. Now, let's talk about the interests here. Who are the main developed countries players in the negotiations, and what their positions were, and sort of really briefly, so that the audience can appreciate this. Bob or Catherine?
Yeah, I mean, first of all, I know we're saying there's a lot of detail missing in these documents, but I will tell you in my experience, there's a lot of detail in these documents that represent an extraordinary amount of convergence, if you will, of views. I don't want people to be misled to think there was speculation before these documents that they would be so full of holes that they weren't really in agreement. I actually think these do represent an agreement, starting with the G7. I think I could divide the world as follows. The U.S. really wants Pillar 2 for the reasons I said, because it wants to raise the rates in the U.S. and get the infrastructure stuff. Many of the European countries really want Pillar 1, particularly, and they want to be sure that the U.S. tech giants are within the scope of these top countries that get taxed. And I think they've kind of convinced themselves that they are. And so now they feel like, okay, we'll get a bunch of profits from them, which is why we got into this to begin with. And so we'll go along. I think the emblematic case here is the UK, which I think has been pretty open about not particularly liking Pillar 2 or even strong CFC rules. Those are controlled foreign corporation rules. But it says we'll go along with Pillar 2 if we can get Pillar 1. And then you get a country like Germany that kind of likes Pillar 2 because it's been a champion of the min tax from the beginning. And it may not have that many of its own multinationals actually hit by Pillar 1. So there could be a certain amount of indifference to that. China is a bit of a unique situation. And to be honest, I find understanding the Chinese role in this, I find China to be somewhat opaque, perhaps like others. So it's not 100% clear. It is clear that they want to soften the min tax rules so that they can still give some tax breaks to Chinese parented multinationals and others. And I guess, and then the developing countries, as I started to say, are a little upset that they're not getting anything out of Pillar 2 and maybe not much out of Pillar 1. And so they've put something on the table called the subject to tax rule, which they also got. And real quick is, in Mike's example, when that Kenyan entity makes a payment into Bermuda, the subject to tax rule says, we don't care if there's a top-up tax in the US. If that's getting zero taxed, we're going to withhold a deduction and pull that tax back into Kenya. And so in that sense, I think the developing countries also got to carve out on some of the certainty stuff for smaller economies. And so in that sense, there's a little bit in it for everyone politically. But what's really important, and there's a very good piece in this morning's Financial Times on this, what's really important is there are many countries that say this is a package deal. We only do it all together. And if the US Congress doesn't go along ultimately with Pillar 1, maybe there's nothing that happens. And Amy, we haven't talked yet at all about these digital service taxes, which are these gross-based taxes. And the reason they're important is, it's my view that when the Europeans said, fine, this is the way I interpret it. When I left government, the Europeans said, oh golly, the US is dragging its feet. It's never going to do this digital deal. We'll fix them. We're going to start taxing gross revenues of the digital tech companies at 3%, and just until the world comes to the table. And that actually did bring both the US government and the US business community back to the table to say, okay, let's come up with a different solution. And that has led to all the current deals. But that's the third piece of the puzzle. In other words, countries have to agree to do Pillar 1, and then maybe countries will do 2, and then they have to agree to give up their DSTs. And as Attiya mentioned early on, if the African countries, don't really feel like they're getting much out of this bargain, will they give up their DSTs? And Nigeria and Kenya both abstained or did not sign up to the document that came out last week. So it's a very, very complicated dynamic, both from the point of view of the intertwining substance and the intertwining timing of all of these provisions going into effect.
So what happens if the EU then enacts a DST? And or I don't know whether the EU will, in fact, enact a DST given the unanimity rules. But, if this happened, what would happen? Would that blow up the entire negotiation?
Well, the EU has said it's going to put out its own digital levy. It originally was July 14th. It's now pushed it back to July 21. The Commission swears it will be compatible with Pillar 1. I'm not sure others agree, and there's back and forth behind the US. I will say this, I'm not an EU expert because I'm an American, but there's the Commission and then there's the governments in the EU. And I think the governments in the EU want this deal. And I think that they will prevail at the end of the day to be sure whatever the EU does, no one thinks is really a DST. But we need to wait to see the details on that.
Yeah, if I can just make a remark, as a European, it's pillar 1 under a EU directive is much better than a EU DST, because DST are the taxes. So I think that the negotiating position of the EU should be, okay, we leave the DST, the digital tax, but then we really have to approve a directive about pillar 1. And this could be a way to convince Hungary, Estonia, and Ireland.
Yes, we have about 20 minutes left, a little less, and let's wrap up with what happens next. And for instance, what happens at the G20 meeting in Venice this week?
The G20 will, I think, almost certainly welcome, appreciate what the IF did, and await the final details in October. It's conceivable that there'll be an extra bell or whistle added at the G20, but I doubt it. It's hard for me to see how the IF didn't deliver everything the G20 would like. Notice, of course, Ireland's not in the G20, Hungary's not in the G20, Nigeria's not in the G20, Kenya's not in the G20. And so in China is, but it's in a way it's an easier forum than the IF was.
So here we have the Financial Times reporting that Ireland, Hungary, and Estonia are opposed, and they say that Hungary, Financial Times says Hungary and Estonia have argued that the agreement would violate EU law because Pillar 2 would have countries where large countries, where countries where where large companies are based, apply the minimum tax rate on subsidiaries in low tax jurisdictions. They're talking about the Cadbury-Schweppes ruling of 2006. What do you think of this, Carlo?
Well, as I said yesterday, I mean, this case is a 2006 case, and if Pillar 2 is implemented as a global tax consolidation, not as a kind of CFC rule, then there is no EU problem. Because if you tax multinational across the board without, so basically the OECD Pillar 2, I don't remember the acronym rule, which is basically the CFC rule, would create problems. But you can go beyond this problem by, with a blanket taxation of foreign profits like the US.
Right.
So, it's a trap. It's a trap because I mean, if you basically apply CFC legislation, you might end up having problem with Cadbury-Schweppes. But if you consolidate foreign profits, period, then you don't have a problem.
So, Attiya, Kenya and Nigeria they're obviously not signing on. What's their thinking?
So, well, I've been asking around, and I want to start from a more African perspective, but briefly. So out of the 54 countries, there are only about 24 that are even party to this 131 that we're talking about. And the 31 is, Peru is also a little different, but we'll leave that alone now. Out of those 24 of them, I was looking to see how many had digital service taxes. So across the continent, only about 16 have some kind of taxes affecting that issue. So that goes to Bob's argument that if they sign on, then these countries would have to remove that particular rule. And both Nigeria and Kenya are countries that have those sorts of digital service taxes. So that is something they would have to give away with this sort of imaginary understanding that they might make some money on the other side. So middle income countries on the continent are less likely to give up revenue for a unicorn tax, which is how I see it, than those who have not got anything coming in. Out of the 16 countries that have it, only 8 of them have signed on, but they have very simple types of digital service taxes, and they're the countries that don't have very big economies when it comes to digital economy right now. So remember, we only have about 30% internet electricity penetration on the continent. So, you know, when you start balancing off all of this and then seeing the reach of these digital companies, you start to understand why the ones who signed on just signed on because there has no effect on them. So I'm going to stop there. Thank you.
Thank you. So we have about 15 minutes left exactly. And we still need to, just in a nutshell, can someone talk about what the process is from here? So what's required before the end of October? I guess that's the next G20 meeting, and the so-called implementation plan. And then what happens after that? We're talking about, I noticed that the July announcement talked about drafting an international instrument or two. How do you implement Pillar 1, Pillar 2, and of course there's the $64 million, the huge question of what the U.S. Congress does.
Yeah, let me take that. I would take this in 2 tracks. One,
okay,
all eyes on the U.S. Congress. Right out of the bat, will the U.S. Congress raise? Remember, our min tax rate today is 12.5%, and we don't do it on a country-by-country basis. So the first thing to watch is in 2021, will the U.S. Congress go along with a 15% rate and doing our min tax on a jurisdiction-by-jurisdiction basis? If they don't, U.S. Treasury is in an embarrassing situation in which they have promoted 15% on country-by-country and couldn't deliver that in the U.S., and that raises other complications. Now let's go back to the OECD track. October, there's a lot of technical work to be done, as everyone's pointed out. Having said that, they've been working technically on this now for a couple of years. By October, they're hoping to button down remaining technical issues. Very ambitious for those of us who have been in the weeds. Then, the way I like to talk about this is, whatever document comes out, let's say it's 150 pages of stuff, technical rules, you still have to take that and turn it into statutory language and treaty language. That itself is not easy. Then the document that came out the other day said it would like to open up a multilateral instrument for signing in 2022. Again, very ambitious. But even if you open a multilateral agreement for signing in 2022, I would refer you, we did a multilateral instrument after BEPS. To put in force many of the BEPS provisions. That document was open for signing in 2017, I believe. And as of today, there are still 30 countries out of 95 signers who have not ratified it, because signing the document is not the same as putting it into effect in your country. So one way to view these timelines in the document is, again, through the political lens, that we need to show the world we're moving fast and this is about to happen. So you, Congress, can go ahead and raise that rate because the rest of the world is coming along, and also to show political momentum, because they would like to have both the Pillar 2 and Pillar 1 in effect in 2022. But as you work through the steps, that taking the political agreement, turning it into technical rules, turning it into a treaty, having the treaty signed and ratified, turning the local law provisions on through local parliaments and Congress, that is a very tricky process. I'm going to close on the U.S. Congress. The piece that will not happen this year in U.S. Congress, because it's just not ready, is the U.S. adopting Pillar 1. Remember, and Mike's paper he wrote yesterday had an enormous amount of the profit from Pillar 1 coming out of U.S. multinationals into the rest of the world. I can't remember the exact percentage. It might have been 46 or something.
64.
64, thank you. And so is the U.S. Congress going to go along with this And that has two subsidiary questions. One, if it's a treaty, it needs 67 votes in our Senate. And which Congress will get to decide this? Today, the Democrats have a tiny majority in our Senate. If this comes to our US Senate at a time when the Democrats don't have the majority, what will the Republican Party think of it? And so there's a great deal of uncertainty. If the US doesn't put that 64% of Amount A profits out for the rest of the world, does the whole deal fall apart? And I think that's the question the whole world is kind of holding its breath on, but too soon to tell.
Okay, we are now at 10 minutes minus our time. So can we wrap up with a lightning round from each of you of 1 minute? Your last words on the deal, the tax negotiations, what happens next?
Carlo has his hand up.
Oh, okay. Well, it's also a comment to Bob, so I take advantage of it. Yes. Well, there is an optimistic alternative scenario, which is based on the seminal idea of the country-by-country minimum tax. So on the one hand, a bunch of countries, including the US, so you need to be optimistic with that, go on with Pillar 2 and tax the multinational global profits. Let's say the G20, just as an example. At the same time, the OECD comes up with guidelines for legislation on Pillar 1, and most market countries swiftly adopt legislation of these advanced rules about, type A income, type B, and so on and so forth. So that would be a reasonably interesting situation that would bypass both, the very complex idea of the international, obsolete idea of an international treaty or OECD level, and the equanimity problem of the directives. So this, I think, is a reasonable scenario. What's your take on it? I think I will close on this optimistic note.
Next, Mike?
Sure, I would look at the long run position. So if we where are we now before any agreement? We have a very complicated tax system, which basically allocates taxing rights to where multinationals have functions, activities, but also where they own assets and where they lend from. We have a very complicated way of trying to figure all that out. We now have a messy compromise, which we've talked about, which is moving simultaneously in two new directions. One is giving some taxing rights to the market. The other is giving more taxing rights effectively to the headquarter companies. Is this a long-run stable solution for the world? I'd say no. It's moving in some interesting directions. I think everybody can, really gets bogged down in the details to some extent when we're thinking about this, and we're thinking about, we're going to make an agreement by October, and is that going to last for 10 years or 5 years or 20 years? I think we're at the beginning of a process. The question would be, can we now say, what principle is it by which we allocate taxing rights of taxing multinationals to countries? The answer is, well, search me. It's almost impossible. Perhaps the principle would be, if we can tax them somewhere, then let's go ahead and tax it. But there is no principle anymore, and there will be no principle. I think this is not a long-run stable solution, and I think there's more to come.
Kathy.
Yes, I'd like to respond to that. And I completely agree that I am concerned about this being a long time stable solution. When you start to look at Pillar 1 and taxing companies based on size, and then maybe segmenting one company for political purposes because you need to get a piece of that so that you can say you're taxing all the US tech companies. When you start to do cliff effects within the tax system, saying if you're over this size, you get taxed this way. If you're under this size, you don't get taxed that same way. You're going to have some gaming around the edges with companies in and out, depending on how they can do that. But I do think that any type of stable system ought to be based on at least some strong rule of law. That means that, something that can last for a long time versus something that can say, okay, we're going to do this for this many years, and then in 7 years, we're going to lower that threshold and add more companies into this, and start to sort of move around the edges of how this is actually working. And if the actual rule of law is, let's figure out how to reallocate, profits from, large multinationals to market jurisdictions, doing it strictly on size because that's expeditious right now is one thing, but having this be a long-term stable system is something that's problematic. We also look at it as, if the OECD if this doesn't work, if the US Congress doesn't do it, business is quite concerned about all the DSTs, and we'll have more of a proliferation of DSTs if this falls apart, which means we can end up with more tariffs on those DSTs if they're discriminatory, and we end up in a sort of a trade war and additional chaos in the system. So having some stability long-term, even if it's not based on the best tax rules, is better than having a system where we are going to have more trade problems and more DSTs and sort of a free-for-all in the international tax system. So we hope that the OECD process works, because the stability and the long-term viability is a lot better for doing business than the alternative.
And okay, about the DSTs, let me note that there's a summary. I've done a summary of where the DSTs, the Section 301 actions in the US on DSTs stand. They're basically all suspended. But the details are in a handout that is posted among the papers for the conference. Bob.
Yeah, so let me just close by saying I think the G7 agreement, the Inclusive Framework Agreement, and I think what we're about to see in G20 is a big deal. I mean, first of all, these things are being covered in the front page of the newspapers around the world, which is not usual for us tax types. But I wouldn't want to underplay what a big deal it is, notwithstanding a very tricky road ahead to get this into implementation, which people could be skeptical that it can be implemented, because if you know this area, it is extraordinarily complicated, as Mike has pointed out. I don't disagree with anything Mike and Kathy said about there needing to be principles and the like, and that's what's making this challenging. But I think also, as Mike has pointed out in a paper, look, it's the first time this idea of let's give more taxing rights to the place of destination has really found, broad support by 131 countries. That's got to be a big deal. It's a big deal for the Biden administration, because they managed to come in and get the whole world to help support their domestic agenda of increasing our tax rate. It's a big deal for multilateralism, because I fully take Attiya's points about the weaknesses in the system of the representation of developing countries. But I think starting slowly, the developing countries are at the table, their voices are being heard. Groups like the African Tax Administration Forum are playing a real role. And so maybe it's a baby step both towards multilateralism and towards bringing developing countries, into the fold. So I wouldn't downplay the success of this. It has a rocky road ahead. And I'm as curious as everybody else on this call and on this conference, where this is all headed. We'll all just buckle in and see.
Attiya.
Thank you. I'm reminded about an Ethiopian proverb that says that you only look down the well when the water has run dry. And I think that the unfortunate situation we're now in is because we didn't treat these particular companies the same as all the others and just start taxing them, in the normal manner. The protectionism that we gave them has now landed us into the big mess that we're in now. And I think it's unfortunate, because with the pandemic and with all the other things happening with countries being financially strapped, we're all now looking at more and more sources of revenue, which means that we're complicating the system more. However, this conversation has reinforced for me that the OECD is the absolute wrong place for this to be taking place. I wish this was happening in the United Nations, where people would have an actual voice that would count. I will reinforce the fact that there isn't consensus when 31 have signed on. It means that people did not agree. But I also know that there was an incredible amount of political pressure put both on my country as well as on other countries that did not agree. And I find it very interesting that a country like Ireland is not willing to move up 2.5%. I mean, that is a conversation which we didn't unpack. I mean, they're fighting at sitting at 12.5. Like that needs a whole debate all by itself. But I think it's really important that we level the playing field. and that everybody gets taxed. And I think as long as we are moving in that direction, then yes, I think we will all be in a better place in the future. Thank you, Annie.
With that, I think we've arrived pretty much at, yes.
Yeah, I
yes,
have a very
Carlo.
stupid question, please. I sent an email to Marcus. Can we get again the instructions how to go online later on at 2:30, right? Because I have 100 emails and I don't know where it was the very first one. Of course, I logged in, so I can access. So can you have the instructions again, please?
Yes. Yes.
Thank you. That would be extremely kind of you because, Marcus said that we just have to log on the website. And what is the link of the website?
Yes.
What
Well,
is-
we'll talk. Let's talk about that after we're offline, because we've now arrived at the magic hour of 8 a.m. my time, and a different time in Nairobi and Italy, and in the UK. So thank you, everyone. I would love to have a round of applause to everyone. This was you were a great group, and I'm very happy that you all agreed to speak today. Thank you again. And with this, I'll bring the session to a close. Thank you.
So it's 2:30 the workshop